All right, good morning, everyone. Happy Wednesday. Thank you so much for joining us this morning. I can say that even in just the last 10 minutes, everybody's in for a real treat being able to speak with Spencer and getting his perspective on the market. Before we get started on that, I just wanted to run through a couple of slides and announcements for our Mid-Atlantic chapter. So first, I just want to say thank you to the committee who make these programs possible, especially Education Committee. Both Cheryl and Kelly have done a great job leading, putting together this session and providing great content for you. Additionally, certainly want to say thank you to our sponsors, annual sponsors, which allow us to put these programs together and provide great networking opportunities for each of you. So we have a couple of upcoming events that we just want to highlight. The Marriott tour is next week, I believe. That's actually already sold out. Over 100 people registered for that in very quick, short order. But please pay attention to the other events we have upcoming with Virginia Economic Development Partnership, Happy Hour, and then most importantly, ERS will be here in the DC market in June. So if you haven't signed up, please make sure that you take a look at that information. So today, I think we can kind of go through this. So today our title is Jeopardy. With all of the dynamics playing out there in the market, we thought this would be a very fitting title. So our speaker today is Spencer Levy, who is the Global Client Strategist and Senior Economic Advisor for CRE, the largest commercial real estate firm in the world. Spencer is a part of the Global Client Care team, a group of professionals around the world who are responsible for account management and client experience programs for the company's largest clients. In addition to his client-facing role, Spencer serves as a primary company spokesperson and is considered one of the most insightful commentators on issues of importance in commercial real estate. He's frequently quoted in the major business publications and is the host of CBRE's award-winning podcast, The Weekly Take, which is the most heavily downloaded podcast in commercial real estate. On a personal side, just some fun facts about Spencer. He was actually once a contestant on The Price is Right, and also knows entirely too much about 70s and 80s pop culture. I highly doubt we'll have the time to ask him all those questions, knowing that all of us have plenty to ask as it relates to what's happening in our market. But with that, I would like to hand it over to Spencer and just highlight to everybody as he walks through his presentation and shares. Please just add your questions into the chat. And as we get towards the end of the presentation, we're going to allow some time for dialogue, and Cheryl will lead the discussion, asking the questions. And if there's time, we can allow people to kind of pop on screen and ask questions to Spencer specifically. So I will pause there and let Spencer take over.
Well, thank you, Megan, and looking forward to speaking to my friends, Mid-Atlantic Cornet. And I will say that we're going to try to answer all of your questions, but if you should put in there your favorite 1970 song along with your question, well, we might get to that one first. So let's talk about the markets, what's going on and what it means for commercial real estate. And I'm going to go slide free today because it kind of allows me to communicate better, but also don't fret, because I've got a slide deck which shows absolutely everything I'm going to say and more. And I promise only to shamelessly plug the Weekly Take podcast 5 or 6 times today. So where are we? Right now, as we sit here on this call, we are what I would call at the moment of peak volatility. And when I say peak volatility, what does that mean? What it means is that the Fed isn't done yet. They're still going to continue to raise rates, and we don't know where they're going to finish for sure. We don't know where unemployment's going to end for sure. But we do know that things have gotten a little better in the last couple of months as the CPI curve has begun to bend downward, better than expected by the market. So that's the good news. The good news is we've got objective evidence of things getting better. The bad news is the worst case scenario is still a possibility. And so the direct advice I give to all my clients is prepare for the worst, but expect better because the evidence is a little bit better. But you should know that notwithstanding the fact I'm going to give you our house forecast, and it's fairly optimistic in about a year from now, there's a material split of opinion among some of the most prominent economists in the world, where you have at one end of the spectrum, the former Treasury Secretary, Larry Summers, who thinks that we are going off a cliff. He thinks that we're going to see the Fed raise rates above 6%, unemployment go above 6%, and things got to get a lot worse before they get better. Okay, that's one end of the spectrum. The other end of the spectrum, there's a notable economist, Nobel Prize winning economist, I might add, from the University of Chicago, Richard Thaler, who is one of my favorites because he has a theory called behavioral economics, which I completely espouse, agree with. And he thinks, and he said on CNBC that, quote, there's no mathematical way we can enter into a recession when we have unemployment this low and we have the growth, the nominal growth, not the real growth. The difference between real and nominal. Nominal growth is before you adjust for inflation. Real is after you adjust for inflation. That's why you see prints of numbers like 0% growth. That doesn't mean we're not growing at. It doesn't mean we're growing at 0%. It means after we adjust for inflation, we're growing by 0%. But the underlying growth is incredibly strong. So, walking in the door with two opposite perspectives, this is our perspective. Our perspective is that the U.S. is going to enter into a mild recession this year. Short and shallow. Boy, those words just roll right off the tongue, don't they? Short and shallow. And I say it quite like that because you know what words rolled off my tongue pretty quickly too? Transitory. That was the key word of last year. It's like, oh yeah, inflation's going to be short and shallow, slow down. Well, it didn't happen, right? And so the biggest risk factor of me saying short and shallow is that it doesn't happen, and it's easy for me to say. So that's why this time the Fed is being so cautious about how it messages, so cautious about signaling to the market that it's going to continue to raise rates, and why I'm being more cautious this time of saying, look, while our house model believes it could be short and shallow, I can't guarantee that because right now we're still in the teeth of the storm. And in the teeth of the storm, we don't know exactly what's going to happen until the Fed actually pivots. And what the Fed pivot means, it means that they are both flattening their rise in rates, meaning they're stopping their rate rises, and then we have objective evidence that they're going to start to decline. And there's a name for that on Wall Street. It's called the pivot party. When that happens, you will see the pivot party, which will manifest itself in the form of a better stock market, spreads coming in on loans, meaning loans getting cheaper, and economic activity improving, certainly not deteriorating much faster. Because I think the reason why you're going to get to a pivot party, unfortunately, is that the Fed's going to see objective signs of recession and that they may have gone too far. So they're going to dip their toe in the recessionary waters before they pivot. Okay, what does this mean in numbers? For those of you that are want to hear it, this is what it means. It means that we think that the long end of the curve, the 10-year treasury, which is the base rate for every loan you have, whether it's your home loan or your auto loan, and for commercial real estate, every loan you get in commercial real estate, we think that that's already peaked, and we think it's actually going to decline a little bit. It's about 3.5% today. We think it'll end about 3.1 by the end of the year and kind of stay there. The short end of the curve is where the whole game is being played, because the short end of the curve is what the Fed controls, and we think that's probably going to go up by another 50 basis points or so, get to about 5.25, stay there. But here's the key point, folks. If you believe this point, keep listening. If not, well, hopefully there's a Dunkin' Donuts down the street and you can have coffee instead. We believe that the short end of the curve is going to stay elevated through late this year and then drop like a rock, drop down to the levels less than half of what it is at its peak, which means that values will improve, lending markets will improve, economic activity will improve starting late this year and then going very well into next year. In fact, I believe that the fourth quarter of this year could be near record levels simply because of the pent-up demand to buy, to sell, to finance, if our predictions, in fact, come true. Okay, now let's shift to commercial real estate. What does all this stuff mean for commercial real estate? Well, commercial real estate right now is in a teeter-totter battle between fundamentals and capital markets. Fundamentals meaning how are they performing from a rent perspective, an income perspective, and capital markets, well, how do you finance these things? Capital markets are horrible, to use a very technical term, and fundamentals are excellent in most asset classes, including several segments of the office asset class. But they're particularly good in apartments, multifamily, in industrial. They're excellent in hotels. If any of you went away over winter break, you know that hotels are not discounting anymore. Retail is doing great. And I've been saying for years that retail is the most undervalued asset class, and doggone it, I'm right. But nevertheless, fundamentals, great. Capital markets, some of the worst conditions I've seen since the GFC. Can't get a loan, no liquidity, banks aren't lending, people aren't selling, people don't know what to value things at. I was at a big event yesterday in Washington, D.C., and it really comes down to this. People don't know what the cost of capital is today, and because of that, they're having trouble trading assets. Okay, so fundamentals good, capital markets bad. Big takeaway there. But let's go through some of the asset classes now, one at a time. First, let's start with the easy ones, the ones where things are really good and going to stay that way, even if we see some slowdown. And that's apartments, industrial, and certain of the sub-asset types, things such as data centers, single family rental, self-storage, life sciences. All these areas are fundamentally performing well, and even doing well relatively well from a capital market standpoint, where you can still trade them and still sometimes get what's known as positive leverage, a spread between your cost of debt and your cost of equity. Now, they're going to slow down. We're going to see, and we did in the fourth quarter see a slowdown in rent increases. In fact, in many places we saw it go negative in multifamily. Industrial is seeing a slowdown. Retail is still going fine. We have not seen a slowdown there. Hotels, we have not seen a slowdown, but nevertheless, we will. And that's going to impact value, as value is simply a mathematical formula of their income divided by their yield. But nevertheless, those are the areas that are doing quite well. And I think they're going to do well for a long, long time, starting with housing. One of the many hats I wear is that I'm the co-chairman of the Real Estate Roundtable's Affordable Housing Committee. And I was at the Real Estate Roundtable yesterday with said committee. And the number that was thrown out by the co-head of Blackstone is that if we had 4 million new units on the ground today, we still wouldn't be at equilibrium. And we're not building anywhere as close to 4 million a year today, multifamily and or single. And so the bottom line is, if you want to be a real estate investor, you could buy apartment buildings, you could buy single family rental. Now, single family rental is controversial. Now it's controversial, and we were in Washington yesterday talking about it. It's controversial because it looks like Wall Street buying Main Street when they go into a community and they buy a single family home. And yes, I'm the first to admit, even though I'm an advocate for many of these investors on Wall Street, that many times when they go into these communities, it will raise the price of some of these single family homes, which is, of course, the bad news for the consumer. But the good news for the consumer is it's better that an institution buys a single family rental than a local owner does, because the institution is well capitalized. That's number one. And number two, one of the few areas of success in the last decade of taking a bite into the affordable housing crisis has been BTR communities, build to rent communities, because when you go into a suburban area, very difficult to build affordable housing vertically, multifamily, but you can build this single family horizontally with a lot less restrictions on what you're able to do. And so the bottom line is, you can't stop institutional capital from going into that space, because they are part of the affordable housing solution. They are not the problem. Unfortunately, that's how it's often couched on Wall Street. Industrial has great supply demand dynamics, even if we do see, and we expect to see, a softening of rents. But what we're going to see now, what we are seeing now, is my investor clients are putting their pencils down. They're not building any of it right now because the inflation is so high. Their cost of labor has gone up. The cost of materials has gone up. So the long story short is that by virtue of inflation, it's keeping the supply demand imbalance very much in the landlord's favor. Now, many of these sub-asset classes, life sciences, data centers, are also remaining very popular. But the problem with life sciences is that it's a very, very small asset class. It only represents less than 200 million square feet. And even though I'm wearing my Michigan vest today, I'm going to give a plug to The Ohio State University, and my apologies to my Michigan friends for what I'm about to say. So I was teaching at The Ohio State University the other day, and I met with the head of real estate. And I asked her, I said, well, what are you building over here? And she said, well, I'm building 150,000 square feet of life sciences. I'm like, oh, well, why are you building that? She said, well, because I don't have room to build 1 million. square feet. Basically, she had demand for 1 million, could only build 150,000 square feet. And it's a story that's being retold at universities, hospital systems all over the country. Excess demand for this particular asset type. And you're seeing developers team up with these universities to do that. What you're also seeing is that many of you who have suburban offices saying, aha, we have the next life sciences center. Not so fast, because in order to have a great life sciences building, you need a demand driver. And that demand driver is typically a large research hospital or research university next to or pertinent to it somehow. And so life sciences is a area that's very hot, but not every building out there is a potential life sciences candidate. On the data center side, and since you're in Northern Virginia, many of you, you could just open up the window and look south. And you know what you're going to see? The data center capital of the world, right where you're sitting. That's the good news. Here's the bad news. Northern Virginia has run out of electricity. When I say run out, they don't have any more electrical capacity to build more of these things. So I don't know that we're going to be building a whole lot more data centers in Northern Virginia unless we have some miraculous change in the energy profile of Northern Virginia. But that scarcity of energy thing is now being multiplied around the country by other things that are not the same, but similar. So for instance, I was just in Phoenix, Arizona. And when I was down there, they had a new data center. I think it was a Google data center down there. And they are getting complaints about this data center. Why? Because the data center uses 20 to 30,000 households worth of water per day. And guess who's running out of water? Phoenix. So much so that there's a suburb of Scottsdale that cut off their suburb from their water supply last week. Bump, right? This is the kind of stuff that's going down now. So when you determine the location of your real estate, you can't just take into consideration the traditional factors of rent and capital markets. You've got to take into consideration the environmental impact, the availability of water and electrical. And then when you're in the multifamily asset class, you have to take local politics into consideration, because let me be clear about this one point. I am a huge affordable housing advocate. I do not, however, advocate for rent control, because rent control limits supply. What only thing that can increase supply is by allowing people to build more. It's as simple as that. And so if you go into certain markets that are going to implement rent control, it will stop the development pipeline. That happened in Portland, Oregon, and other markets that have attempted it as well. So let's now go to the star of the show, or the one that's most close to many of you, which is the office asset type, and what's happening there, and what does it mean both for investors and for occupiers. So first of all, I can't believe it's taken me 18 minutes into today's show not to make a shameless plug for the #1 podcast in real estate, The Weekly Take. And why am I making a plug for the podcast that I'm fortunate to host? Because last week on the show, we had the CEO of a company called Victrix on the show. And what was he talking about? He was talking about the conversion of older office buildings into multifamily. And he's doing it all over, primarily in the Midwest, which is great. But here's the punchline. The punchline is he's buying these buildings for a song, like $25 to $50 a foot kind of a song. And just so you know, that in the best office markets, office buildings often trade at or near $1,000 a foot. So you can see there's a big delta there. Here's the other punchline to that. And this is a tough pill to swallow in Washington, D.C., is that there are a lot of buildings in DC that are underlet, that are older, that look perfect for multifamily. Here's the problem. Not only do they have large floor plates, which makes it difficult to get light and air into these units for apartments, but here's the more difficult part. Because of the way they were constructed, you simply are not able to cut through the slab, which would make the building structurally unsound. So there are a lot of buildings in the DC area that unfortunately are going to have to come down, because there's no other viable economic outcome from them, whether it be multifamily or keeping them as office. So it's a tough problem, even under the best case scenario. And the best case scenario is that the office market comes back better than we hope, and we get state and local incentives to convert some of these buildings. But what do we think is going to be happening in terms of the office sector? Well, there's a lot of different angles to this. I'll hit it from a few. First, from a owner perspective, the best office buildings are performing extremely well. When I say extremely well, they're still getting positive net effective rents. You're seeing what's known as a flight to quality. Some people who have been in older office space can move into new space, but they're taking like 1/3 or to 1/2 of the space they had before. So their overall rent is not going up materially because they've reduced their footprint. The other thing you're seeing is this move to new sub-markets, right? So until 10 years ago, everybody that was in the lobbying space wanted to be within 3 blocks of the White House, right? K Street, whatever it is. And so now go to Washington, D.C. You know what some cool areas are? The Wharf. You know what's going to be really cool? Bristol City, where Amazon just moved. New submarkets. And what do these submarkets all have in common? Live, work, play. Many of them have a university anchor to them. And you see it all over the country. So one of the slides I'm going to show you is going to show you the top 30 submarkets in the United States. And people will often ask me, would you rather have the best asset in a mediocre submarket or the worst asset in a great submarket? I always pick the latter because that asset can be fixed through CapEx. You could turn it into a better office building. You could turn it into multifamily or something else. That asset that's in a mediocre submarket, you can't fix foot traffic. That's very difficult to fix unless somehow you have a miraculous improvement of the whole neighborhood, which could take decades. And so submarket matters more than necessarily the physical quality of your asset. But the best thing to have is obviously the best of both worlds. The best asset and the best submarket will win. And many of these submarkets are in some old school cities that a lot of people don't necessarily want to be in from an investment standpoint. Cities like Philadelphia, not the #1 investment city. But if you go to University City, that happens to be our #1 submarket. You can go to Columbus, Ohio, not the best investable market, unless you go to South High Street, which is between downtown and, yes, the Ohio State University. Great street on which to invest. And so you've got to look for these submarkets that have these live, work, play characteristics, university bases. The hip cool factor matters a lot as well also. So now let's turn to the occupier perspective. And there's 2 basic perspectives here. One is the perspective of return to office. The other is where and when do I pick my next space? Do I downsize? Do I move someplace? All right, return to office. And I was having this conversation with the Cornet team just prior to this call. And I said, look, the bottom line is what we're dealing with in the office today has nothing to do with office. It has everything to do with labor versus management. And I mentioned that, and I put this little teeter-totter thing here on the screen, very fancy graphic right there, right? I put it on the screen because I studied in college at the Cornell School of Industrial and Labor Relations, labor. And I studied it in the mid-1980s. And when I was studying labor, what did we learn? We learned that labor had both perfect information and perfect mobility. That was false and falser in the mid-1980s. You know when that's true? Today. And it got particularly true during COVID when people figured out that, oh boy, I can work from home and get stuff done and I'm happy. But the point is that that's one part of it that can't go away. We can't stick the Zoom genie back in the bottle, nor would we want to. We wouldn't be having this meeting right now, right? Without the Zoom thing. But what you are going to see is this teeter-totter of labor versus management shift. It's been shifting, I don't know, for the last 200 years, it's always shifting. And I think labor's power probably peaked in the mid-1950s when union power was at its strongest. And it probably was at its weakest, probably just prior to COVID. And so we're going to see it shift back, and nobody wants to see more unemployment. But if there's anything as such as a silver lining to more unemployment, is it will shift some of that power back to management, and more people will come back. And more people will come back depending upon the size of the company, the industry, the job function, and then the life stage of the individual who is choosing to come into the office or not. People that tend to have kids like me want to be in the office less. I drove my daughter to school today. If she had an event this afternoon, I'd be going. the bottom line is that the change in the power dynamics between labor and management is the key to getting people back. It is not the hyper amenitization of your space. And so I had on my show, yep, here comes another shameless plug for the Weekly Take, Thomas Neltner, who is the head of real estate for Fifth Third Bank. And he was talking about that people are in Fifth Third Bank's offices 3 days a week, Tuesday, Wednesday, Thursday. And I was there on a Wednesday. I couldn't get a parking spot. It was full. But one of the interesting takeaways of that wasn't his strategy on the days per week, was his strategy towards amenities. Because a lot of people want to make the office like people's homes. Not me. I want to make the office different and productive and something that is a destination they can't get from home. We have in some of our CBRE offices in DC this beautiful thing called Liquid Galaxy. Let me tell you something. I got 3 screens sitting here in my office. Ain't none of them Liquid Galaxy. I also can't get the big conference rooms. I also can't run into people at the coffee counter in my office. When I go to my office in DC, I sit in my coffee room. Why? Because it's wide open and everybody walks in. I was there a couple of weeks ago and people just keep walking by. Bottom line is this. There are things that you want to have that are like your home, things that you want like your office, and it's not always making them the same. So here's a funny story for you. So I'm often asked, what is the #1 amenity that you can put into your office, since we're talking about amenities? And so I'm very fortunate in that I travel the world. I see corporate workplaces, I mean, everywhere, every industry, everything. So when I go to Silicon Valley, what do I see in the corporate workspaces right on the floor, right in the middle of Cube Farms? Bars, bars. I'm talking like booze, not like wine and beer. I'm talking like the real stuff. And why is that sitting there in the middle of these, Silicon Valley places? I'll tell you why. Because they don't want people to get drunk during lunch or abuse that. They put it there because it creates an environment of trust. It shows the employer, shows the employees that you trust them, and the employees self-enforce the trust that nobody's really going to be drinking that stuff during the day anyways. And, we have an office in Colorado. We just took the Molson Coors old space. So we have beer taps built into our offices, and we have locks on those beer taps until 4 o'clock in the afternoon. And I tell my team, I say, take the locks off the beer taps. And they're like, oh, we don't trust our people. I'm like, well, if you took the locks off the beer taps, they'll trust you more too. So in any event, my company allowed me to write an article about why a wet lunch would bring people back to the office. I'd write it. And the reason I'd write it is not because people are going to get drunk during lunch, because what's happened over the last 20 years is the business lunch has shifted into the business dinner. And truth be told, even though I'd love to have lunch or dinner with every person on this call, I don't like having business dinners because it keeps me away from my family. And business lunches, if you could do that, would be yet another type of thing that could bring people back to the office. But yes, I know it's a controversial topic, but I'm just trying to think outside the box here, folks. So when do we get to the new normal? What does it look like? Well, the new normal has not been reached yet. Right now, we're looking at occupancy in your typical office, 55, 60% at best, maybe a little bit more, in some places less than others, but we're not at that new normal yet. I think the new normal stabilizes at about 75% of where we were pre-COVID. So we've got a ways to go. But I think it also means that there are going to be some days of peak demand on, I'm going to guess, Tuesday, Wednesday, Thursday. And on those days, you're still going to need about the same amount of space, but the space is going to change a little bit in that many of our corporate occupiers are now taking a higher percentage of their space, not necessarily direct space, but some co-working space, WeWork, Industrious or otherwise, so that they can have that extra space when they have moments of peak demand. When does that happen? I think we reach this moment of new normal probably sometime late next year. I don't know exactly when, but it will be related to how the economy performs, because if we see more unemployment, people will want to come back to more to the office, and then of course vice versa. So let me sum up my comments here, and then I will take whatever questions you have. I hope you're populating the chat room or thinking about your questions, or Megan's ready to take us off the spotlight and put us into the Hollywood Squares zone. But the economy is going to be in for a tough go of it, at least for the next 6 months, until we get to that pivot party, which is when we believe it's going to get to that pivot party, at which point economic activity will return, particularly from the capital market side. Employers will have confidence to lease more space. And if we do see the other side of that coin, more unemployment, people will come back to the office more than they are today because of that change in labor versus management dynamic. Washington, D.C., you are going to see a fair bit of conversion of some of these older office buildings into multifamily. The better office buildings, that people are just going to put CapEx and make them, keep them as office buildings. But ultimately, Washington, D.C. has a unique issue as it relates to some of these buildings from a structural standpoint, can't be converted. And that's where the problem lies. But even there, there's solutions. So with that, I'm here to take any questions you got. Megan or whoever would like to run the Q&A, please open it up. Okay, we got 2 questions in the chat room. Here we go. Some for person with the initials DL. Thank you, DL. I'm interested in his thoughts on the construction labor market and if there may be any improvement. The short answer on the construction market, it's got 2 components to it. One is the cost of materials, and the second is the cost of labor. Materials costs have come in because many of these material costs, like asphalt, which is a oil derivative, steel, wood, things like that, those costs have already come in. And the reason is those are some of the same materials that are used in single family, and single family has been in a recession now for 6 months or more. And so that caused those costs to come down. Construction labor costs have still continued to rise, but they are beginning to plateau. And the reason there is many of the people that do construction on single family also do it on commercial as well. But the bottom line is this: labor prices never go down. There's a concept in economics called sticky prices downward. You will see the rate of rise slow and flatten, but as far as the prices of labor coming down within the construction trades, unlikely to happen. But the reason why people will begin to build again is because materials come down, and then of course interest rates will come down, making it cheaper to build as well. Oh, I love this question from AJ, and I don't want to mispronounce your last name, Grulich, I think it is. So thank you for your question, AJ. Would the DC office market improve if federal government required all employees to return to the office? Well, where was I yesterday? I was at the real estate roundtable. And who was I with? Not only some of the biggest real estate owners and developers in the world, but also I was there with multiple senators. I was there with Senator Menendez. I was there with Hakeem Jeffries, the new minority leader in the House, and multiple other people. And what did every single person in that room ask them is, why don't you require federal employees to come back to the office? Well, the good news is Senator Menendez from New Jersey said he's requiring all of his staff to come back into the office, but we need a greater mandate for people to come back into the office. And they all know why. Because if you let these office buildings wither, so will the tax base, so will that little restaurant down the street, so will the mass transit system that requires ridership to finance its ability to operate. So yes, if federal employees were required to come back, DC would get a whole lot better quickly. Problem is, it goes right back to what I said before. It's a labor versus management thing, and there's politics involved here. It's not just real estate and taxation. So you need to see some shift in that labor versus management dynamic, as bottom line as that sounds, before you start seeing the feds start requiring employees to come back. Okay.
Isn't there a bill on the House floor, the Show Up Act or something? I read an article about, like, some in Congress are trying to.
They are.
Yeah.
They are definitely trying to. I don't know if that you very well may be correct. I'm not familiar with that particular bill, but there's a lot of people trying to require people to come back for all the reasons you just laid out.
Because if the government does it, then their contractors are going to have to follow in suit. So it'll be a domino effect. Yep.
Yes.
Thanks.
Oh, okay, you bet. Okay, so let's keep going here. So thank you for your question. Let's see here. Do you see rents decreasing in these high vacancy markets like DC? Well, this is really a math question, Pierce, because let me give you an example, a case study, very small case study. I was playing golf the other day with a client of mine in New York, and he was saying he just rented his space in Midtown Manhattan for $55 a foot for 10 years. But what he did was he gave that tenant $150 work letter and then a 2 years free rent. So if you want to do the math, that means that this landlord won't see a dime for 6 years. So there's a point at which the landlords cannot decrease rent. So I know this is Cornet, and so most of you are occupiers. And so as an occupier, you say, oh, I've got all the leverage in the world. I'm going to ask for less rent. Well, there's a point where the landlord can't do that. And that's point A. And point B is most of the large many of the large corporate occupiers, some of which are represented on this call here today, are going to higher quality space and actually paying more, a lot more, because they're using the office as a place to attract and retain tenants rather than one in which they just try to get the lowest cost rent. So yes, net effective rents are already dropping in the Class B segment. What a net effective rent is rent after you take into consideration tenant improvement allowances, free rent, and commissions. They are still going up in the high quality office, particularly in those good submarkets. So yeah, rent will go down in the Class B when you take net effective into consideration, but be careful what you wish for. Would you like to be a tenant in a half full office building paying less rent? Or would you rather be a tenant paying a little bit more in a high rent building that's vibrant? So again, it's just a different way of looking at real estate from a productivity standpoint versus an efficiency standpoint. These are my two favorite words in real estate. I always put my eggs in the productivity basket, which means that you get what you pay for, versus the efficiency basket of saving that extra dollar may cost you too. Okay, let's keep going down here. You mentioned the short side declining in your comments. Can you explain that more? Sure. So when you take a look at interest rates, there's what's known as a yield curve. And here's my fancy yield curve. You see that? This side is the high end of the curve, which is long-term rates. This side is the short end of the curve, which is short-term rates. What's happened during this period is it's reversed. It's inverted. Short-term rates are higher than long-term rates, which has always been a harbinger of doom for recessions when you go back many, many years, looking at it as a leading indicator. Now, the short end of the curve is really important because if you get a home loan, you can get what's known as a fixed rate mortgage, or you can get a floating rate mortgage. The floating rate is based on the short end of the curve. The fixed is based on the long curve. And what's happened now is because both of them are elevated, home loans have gotten expensive. Construction loans have gotten expensive. But that's the bad news. The good news is we think that the short end of the curve is near its peak right now and will begin to decline in about 6 months. And when it declines, it will decline rapidly down to an area where it's less than half of where it is at peak. So the bad news is where it is today, which is a harbinger of recession. And as I mentioned, I said the word short and shallow. We think the recession is coming. That's the bad news. The good news is we think that towards the end of the year, will drop very quickly. Okay, question. Spencer, what impact does CBRE see with the general government chaos, i.e. the Congress and the debt ceiling? Well, good news is yesterday I was with all these Congress people, senators and Congress people. And that question was asked multiple times. Even though the Democrats and the Republicans, and we had both at the event, had slightly different perspective, there wasn't a person in the room that didn't think a deal was going to be cut. There's not a person on the Republican side of the aisle. That's not true. There may be people at the fringes of both parties that wouldn't mind using the U.S. full faith and credit as a lever to get what they want. But the bottom line, nobody wants to see the U.S. government default. The government will not default. Even if it defaults for 30 seconds, right? It will undefault about 30 seconds later. Nobody is worried about the full faith and credit. And what was said, and I think it was most productive, I think this whole debt ceiling calamity that we keep going through every couple of years, it's got to end. And that's what some of the Republican, French Hill, a Republican congressman, was saying, like, this is ridiculous. And he's a Republican. saying that we've got to find a way that we don't keep going through this every year. So no, I'm not worried about the debt ceiling. It's a short-term issue. It's purely political, and we'll get past it. Next, Spencer, can you jump back to the discussion of recession? We saw negative GDP numbers over several quarters, but unemployment is back to pre-pandemic. So are we really in a recession or not? Well, Megan, you should know that if you had put a 1970 song reference in that question, I would have gotten to it sooner. But in any event, we're here now. So here's the thing. A technical recession, in a classic sense of the word, is 2 consecutive quarters of negative GDP growth, okay? And you say, well, didn't we have 2 consecutive quarters of negative GDP growth last year? Well, we did, but the Bureau of Economic Analysis said, well, we're not really in a recession yet because of exactly what you just said, Megan, because unemployment is so tight, because nominal GDP growth is so strong. The bottom line is this: a recession will start when the BEA says there's a recession, and that will be when we see a significant rise in unemployment and nominal GDP growth go down, and other objective indicators of recession, including wage growth slowing down and flattening, because right now that's probably the number one risk factor, both wage growth and the services sector continuing to rise, which will keep the Fed in what's known as a hawkish stance, wanting to continue to raise interest rates. So it's a long, fancy way of saying this, Megan. We believe there's going to be a recession. We think it's going to be mild for some of the reasons I just laid out, but it might not be. It might not be if some of these numbers come in bad. Bad meaning that wages go up too much. And again, I want everybody to get paid more, but not right now, because right now we need to see things cool down. We also want to see, we don't want to see unemployment go up, but if it goes up by a lot, that would be another way for the BEA to say, okay, yes, we are in a recession today. But no, even though we've seen 2 negative prints on GDP, and some people think it technically constitutes a recession, the U.S. government does not. Okay, new message down there. I hope there's a 1970 song reference here. And we'll keep on fighting until the end. Is that a song quote? I hope that is. I'm normally like the king of getting these song quotes immediately. I don't remember where that came from. We'll keep on fighting, and I'll come to me in a second. Okay, so if the market starts to bounce back in Q4, does that give us enough time to normalize inflation and provide a Queen? We are the champions. Thank you, Megan. You win. Nicely done. Nicely done. So, okay, so if the market starts to bounce back in Q4, does that give us enough time to normalize inflation and provide a little reprieve on pricing? Yes, it does. And because if you take a look at the prior history, and again, yes, I have charts on this. What happened this time, it is the fastest increase in interest rates in history. We've never put our foot on the gas quite this quickly. And the theory is if you go up, what goes up so quickly may come down quickly as well. But nobody really knows because we've never been in this circumstance before. And to use a somewhat colorful analogy, the Fed has 2 tools in which to tame inflation. One is rising interest rates. The other is the bully pulpit where they talk it down. And it's like using a chainsaw to do delicate surgery. So we don't know for sure. But the theory is that it will provide a relief in pricing. It will allow us to get back to normal economic activity. But no, we won't be back to normal economic activity in the fourth quarter. What we will see is objective light at the end of the tunnel, meaning that we'll have momentum going into 2024. But things will get better from a capital markets perspective, because the capital markets always go into the recession first and they come out of it first, and fundamentals lagged. So you're probably going to still see weak fundamentals going into 2024, and the fundamentals are unlikely to go back to improving till late in 24. So that's just how the market works. Capital markets lead us in, capital markets lead us out, fundamentals follow. Okay, we are the champions, 1977. Anything by Billy Ocean. Well, Fran, you should know I only know Caribbean Queen. If you could name a second song by Billy Ocean, I will answer your next question. Brendan M. Group Architects. I was at the event yesterday where they discussed DC's growth, stating it is stunted by pandemic and the Fed's not coming back to work. to the levels we saw in the 80s with crime ticking up and empty sidewalks. Is the answer to revitalize, to pivot these GSAs and office leases to mixed use, creating new submarkets like NOMA and the National Landing? Okay, well, look, I don't want to go too deep into the crime thing, but it gets brought up a lot more than it's ever been brought up. And folks, look, I live in Baltimore, okay? So I get it. I've been living with it my whole 22 years I've lived in this market, but I never used it as an excuse not to move forward with economic activity. But nevertheless, I get it. And it is something that stops some people from coming back downtown. But yes, so a couple of things within this question right here. First of all, the GSA coming back to the office would be a big deal because it will create a virtuous cycle, both with respect to restaurants and other pertinent uses nearby, but as importantly for government contractors, which are going to likely have to come back as well. Would redeveloping some of these into mixed use help? Sure, it would, but it takes a long time and a lot of money to do that. So it's not something you could do tomorrow. So the wharf, I remember when the wharf was thought about. I remember when it was just an idea. Okay, 10 years later, it was built. I was stood on National Landing when it was literally a forest, and there was some bald eagle that lived in a tree on National Landing. That because it was there, it held up development for 5 years, and now it's great, right? So all these things are great, but they take forever. Now, here's where you get a very, I would say, complicated and sometimes politically fraught debate. Are you better off building in CBD, Washington, D.C., or are you better off building in a new place like National Landing, like the Wharf? And so I had, yes, shameless plug for my podcast. On my podcast on Friday, I interviewed the global head of real estate for Ford Motor Company and their head of their innovation district in downtown Detroit. Ford, putting aside their Dearborn assets, where they own most of the town of Dearborn, they bought an old train station in downtown Detroit, which I believe they now call Michigan Central. And I said to them, I said, look, you don't control the land around it. How do you do it? So, well, we work with the city so that everybody's involved, the community's involved, we can build more. But I would say that is the exception, not the rule. The rule that I normally see is exactly what you suggested in your question, is that building outside of existing areas is easier. So another podcast I did, yes, I told you I was getting my 6 shameless plugs in, whether you liked it or not. One of the podcasts I did about a year ago was for a development called Lake Nona down in Orlando. And if you haven't visited it, you should. It's right near the airport, so it's easy to get to. Any event, it's about 2/3 the size of Manhattan, and they have world-class hospitals, the largest VA hospital in the state of Florida, the largest children's hospital in Florida, world-class golf course, innovation center, different forms of housing. And how did they do it all? The Tavistock Corporation owns the entirety of the 2/3 size of Manhattan. So they weren't answering to anybody but themselves when they wanted to build new. So this is the challenge. The challenge is it's easier to build in places where you are the only decision maker. The problem is, what do you do with the CBDs? And so there needs to be some type of political compromise in these CBDs, or they will wither, because this is a tough statement I'm going to make, but I make it in every city I go to. Your city is immobile, but capital and labor will go to the place where it is best served. Capital where it gets the best return, labor where it has the best job and the best life. So if you think like, oh, everybody's going to come to DC, it's not the case. They're going to go to the places within DC or in the region or outside the region where they have the best opportunity. Okay, so Billy Ocean, can you feel it? Thank you, Fran. Boogie Wonderland. Billy Ocean did Boogie Wonderland? Really? I got to look that one up. Somebody confirmed that it was Boogie Wonderland for Billy Ocean. I did not know that. I should have known that. Here we go. Didn't the Netherlands pass a law requiring companies to offer work from home? Anything novel you were seeing from Europe? Look, you got to understand something. Europeans and Asian countries are culturally very different and generally speaking, much smaller than the United States. And so because of that, actually what we've seen in Europe and Asia is more people going back to the office than they are going back in the United States. And some of that has to do with in Asia, for instance, most apartments in Singapore and Hong Kong are 1/3 the size of a typical American apartment, and people want to go to the office to get out of their apartments. So there's a lot going on here beyond just the mandate of the law of saying you have to or you don't have to go back to the office. From my perspective, people will go back to the office when they have this labor versus management thing shifting. But also, and this is a tough comment to make about the US versus elsewhere. Our culture simply isn't as cohesive as it is in some of these other places. And so in Asia and in many places in Europe, people are moving back into the office because everybody else is. And it's just, they think it's collectively better for everybody else. Unfortunately, one of the negative ramifications possibly of our fractured political environment is that people aren't going back into the office in part as a result. Okay. Billy Joel, we didn't start the fire. That is not a 1970s song, sir, Hank, but very good. Well played. But 1970s, that song came out in like 1983. And I actually had the album. Will DC change its height restrictions on buildings outside the CBD? But thank you for your question, Hank. So the short answer is no. And the longer answer is they have, you know where they changed height restrictions or where they don't have height restrictions? Southern Maryland. They have it in Northern Virginia. That's why people go to these places so they can get greater vertical density. But within the district itself, I see that as the impossible dream. And if it does happen, it would take 30 years to have any possible impact on it, because the reason why DC looks like it does is because our good friend Benjamin Franklin walked the streets of DC and was a big Paris fan and tried to make DC look like Paris. And so if you go to Paris, and many of you have been there, I've been there, it actually reminds me a lot of DC because buildings are all about the same height and they have all this light and air. Compare that with going to downtown Manhattan. Go to downtown San Francisco. It's cavernous. That's not going to happen in downtown DC. And that, does that create a competitive disadvantage for downtown DC? Well, let me give you an analogy. I was just in Denver last week. When I look at my travel schedule, I was everywhere last week. And when I gave a speech in Denver, I said, look, I love Denver because Denver has all these positive demographic trends. They're putting a train out to the ski mountains, tech companies. I mean, you name it. Denver's got a lot of good going on. The one bad thing they got going on is height restrictions, because while they have tall buildings in the CBD, once you get a block outside of that, you're only allowed to go up like 4 stories. And then buildings, multifamily goes on for miles. And what's the implication of that? The implication of that is that all of my colleagues that work in downtown Denver and live in downtown Denver drive to work, because bike lanes, they say they're going to get killed on a bike, but also they have to move further and further and further away from the downtown in order to find housing. So I don't like height restrictions at all. However, because of the history of DC and Paris, I simply see no chance of them going away. Okay, let's keep going here. Fran, please comment on the innovation center craze going on with corporations. Okay, so as I mentioned a moment ago, I was just in Detroit on Friday with the head of Ford Real Estate and with the head of their innovation center. They're not calling it an innovation. Funny you use the term innovation center, Fran, because they specifically are trying not to use the word innovation center because it's so, I don't know, trendy maybe is the right word for it. And that's why they call it Michigan Central, but excuse me. But it's still an innovation center. They're going to have smaller companies in there that are sort of startups to create this vibrant buzz going on in the building. And it speaks to what I think is the most important thing for your real estate, to be either the physical structure or within, more importantly, in a submarket that has a virtuous cycle. What is a virtuous cycle? A virtuous cycle is when good things are happening all around you and then they multiply. And that's why so many of these great innovation centers, for those who term it that, are near or on university campuses. I believe an innovation center is being built on the University of Maryland campus in College Park. But there are many corporations that are trying to create innovation centers within their headquarters buildings. Why? not just for the selfish need of maybe we can buy these companies one day, but it also creates this vibrancy, this virtuous cycle of where people want to be. People want to be where the action is, and whether it's for social purposes or for business purposes, and that's what innovation centers create. So I would say, and actually, now that I'm thinking about this, Fran, if we were to have a number one amenity for a building, it wouldn't be co-working space, it wouldn't be outdoor space, it wouldn't be even a bar. It might be having an innovation center in the building, because it creates this vibrancy which benefits everybody else. Okay, we are now at 9:55. We have time for a couple more questions. Given the focus on lowering carbon emissions by corporation, isn't having less office space a solution? Well, I think that when you look at carbon emissions, okay, there's the whole science of carbon emissions as it relates to commercial real estate is evolving, but it really breaks into two basic categories. Category A is the emissions from the building, when you burn energy to heat the building, okay? That is the most common definition. That is a definition that was historically used by GRESB, the Green Building Council, and by Energy Star. But now there's this new emerging definition, which is the construction of the building materials you use to build that building. And so did you know a wood framed window is multiple times more energy efficient than is a steel framed window? And obviously wood is more efficient than steel in terms of the energy used to produce it. So to your question, is less office space, is less anything more energy efficient than more anything? Sure it is. But ultimately, technology is changing today so that new buildings, or what I actually prefer is the retrofitting of older buildings, because there's nothing greener than reusing old materials, is a better path forward than stopping new construction. I respectfully would disagree with anyone who thinks that stopping new construction is the solution to anything. And the best example I will give to that is affordable housing. We have stopped new construction of affordable housing, and now we have a massive crisis on our hands. And a lot of that stopping of new construction, and I say this with respect, was done for green reasons. And so we need to balance the green with the economic progress that is necessary in order to come up with great solutions to make sure that the new buildings are still green, but nevertheless, we need the economic activity to keep moving forward. You may say I'm a dreamer, but I'm not the only one. Imagine. It's easy if you try. That was great from John Lennon, but also a great clip from the movie Forrest Gump. Could you speak to the refinance lending activity, both debt and equity requirements for commercial office? Okay, this will be our last question because we have
our last question. Okay, great.
Okay.
Thanks, Spencer.
So the debt markets for commercial office are as difficult as I've ever seen. Unless you have the best office building in a great submarket and it's fully leased, your odds of getting a loan are very, very, very limited, because banks right now are being told by the regulators to unload some of their office loans that are on their books rather than create new ones. So very difficult, but for the best buildings, you could still get a loan. It's just very expensive, and very expensive to me is 300 basis points wide of where it was early last year. From an equity requirement, the cap rates that people are paying for these buildings are 250 to 300 basis points wide for where they were last year, even for some of the best stuff. And for some of the worst stuff, and I say this with love, just a fact was given to me by my Los Angeles team. If you're in downtown LA right now, even buildings that are almost fully leased, they're a couple years old, they at the moment, spot market pricing, not long-term pricing, I've seen a value diminution of 50%. So office class, anything but the best of the best office is just having an incredibly tough go of it right now. All right, well, I think we're out of time.